I hold the view that it generally is the private sector that can most reliably and efficiently provide goods and services to the economy. And I apply this view to the payment system as well. It is that perspective that underlies a question I often ask when forming my positions on the appropriate role of the Federal Reserve in a variety of initiatives. What is the fundamental market inefficiency that would be solved by government intervention and can only be solved by government intervention? If there isn't a satisfactory answer, then I believe government should intervene in private markets. Does this mean I believe the Federal Reserve should not be involved in payments? And the answer is no. Well, I generally believe that government shouldn't directly compete with the private sector. There are situations where government involvement is needed to solve for market inefficiencies that may arise because of things like incomplete markets, coordination problems, and a lack of resilience. As a policymaker, I have applied that same question to issues ranging from bank regulation to monetary policy. For an example, in the payments area, 3 years ago, there was an increase in public discussion about creating a new payment instrument called a central bank digital currency, or CBDC. The Federal Reserve Board was compiling a report and seeking public comment on the potential benefits and risk of the idea. In a speech I gave in August 2021, I asked, what problem would a CBDC solve? In other words, what market failure or inefficiency demands this specific intervention? In more than 3 years, I have yet to hear a satisfactory answer to that question. Given today's audience and my position serving as the chair of the board's payments committee, I want to focus on the important roles the private sector and the Federal Reserve play in our ever-evolving payment system. To set the stage for that discussion, I think it would be helpful to recap some history around payments and clearing in the United States. In the early decades following the country's founding, banks generally had state charters. While state banknotes and checks circulated locally as payment instruments, there were difficulties clearing and settling checks across states. One way of describing this is to say that the early U.S. payment system suffered from incomplete markets. The Second Bank of the United States was created in 1816, and due to its federal charter, it was able to create a national system for clearing checks and banknotes. This in turn led to a more complete national clearing and settlement process. When the charter for the Second Bank lapsed, clearing and settlement of banknotes and checks fell back to state-chartered banks. Many of the earlier inefficiencies simply resurfaced. For example, porters in New York City would deliver checks and exchange them for gold and other coins and then transport that specie to the payee. Hauling these money bags around New York posed obvious risk, and these risks multiplied by the mid-19th century, when the number of banks in the New York area grew rapidly. As this audience is well aware, the New York Clearinghouse Association was founded in 1853 and served as a central location for the clearing process, which soon evolved with certificates replacing coins. Furthermore, by being part of a common infrastructure, all members had a reasonably good idea of the quality of each other's balance sheets. In modern economic language, the New York Clearinghouse became a coordination mechanism that improved clearing by getting banks to clear and settle payments in a well-organized manner. It also reduced asymmetric information about the quality of member balance sheets. By performing this function for New York banks, which constituted a relatively large share of the U.S. financial system, the clearing and settling of payments improved nationally. In this sense, the New York Clearinghouse was the closest thing the United States had at that time to a central bank. While this was an improvement, not all important financial intermediaries were members of the New York Clearinghouse or other such private arrangements. That is, there were gaps in the payment system. And financial panics, sometimes driven by these gaps and problems in check clearing, were a regular feature of the 19th and early 20th century. The Panic of 1907 was a classic example of that. Depositors and investors lost confidence in certain New York banks that had been combined into large, complex, and opaque trust companies that were not members of the New York Clearinghouse. This resulted in runs on those trusts, which led to broader liquidity problems. Although the New York Clearinghouse had the ability to provide liquidity to those trusts, the provision of that liquidity was delayed. It appears that at the time, the New York Clearinghouse was reasonably observing some form of Bagehot's dictum when deciding whether to provide liquidity. Under that dictum, you want to know that the institution to which you're providing liquidity is solvent. If it isn't, then liquidity extension could be akin to throwing good money after bad. But because the trust companies at the time weren't member institutions, the clearinghouse didn't have a good enough understanding of their balance sheets to know whether they were solvent or not. Some banks refused to clear checks from other institutions, which led to an erosion of depositor confidence and more failures. This historical example points to another aspect of a payment system for the country that is important: resiliency of that system. These problems highlighted by the 1907 panic, coordination failures, and a lack of resilience could have been mitigated with the help of a central bank. Paul Warburg, an influential banker at the time, argued that such a central bank could establish and maintain a perfect system of credit, enabling the general banks to transform cash credits into actual cash with such absolute ease and certainty. The use of cash credit instead of actual cash will not cease no matter what may happen. In 1913, Congress agreed and created the Federal Reserve. It positioned the Federal Reserve at the center of the banking system by establishing a nationwide check clearing system and a telegraph, I love this, and a telegraph wire transfer service that is now known as FedWire. We still use the wire. The Fed was also intended to function as a lender of last resort so that suspension of payments would no longer be necessary. In the 1970s, the Fed promoted more efficient check clearing by adding the automated clearinghouse service. Our job in providing these services and carrying out our responsibilities was and continues to be to make sure that payment systems function efficiently and resiliently, promoting the kind of confidence that is vital for a modern economy. All right, I'm done with the history lesson. The lesson from this history, as relevant now as ever, is that the payment system has been one of those areas in which the best efforts of the private sector have sometimes fallen short. The decentralized and diverse nature of banks in the United States is a feature that goes back to the 1800s and has the merits of promoting competition and a vibrant economy. However, when engaging in clearing and settling of payments, coordination problems, information asymmetries across banks can be and were destabilizing. While the private sector made advances in resolving those issues, the panic of 1907 showed that those steps were not sufficient. As successful as the New York Clearinghouse was for its members, it could not protect its members and the economy from risk in the growing share of finance occurring outside its walls. This contributed to the motivation to establish the Federal Reserve and its role in payments. Now, fast forward to today, and we are once again in an era of rapid change and innovation in money and payments. I like to often joke, if you told somebody 20 years ago that payments would be the coolest tech job in the United States, they would have laughed you out of the room. Now, some of this innovation will not pan out. Some of this change is about delivering services readily available, but doing so with new technologies. And some of it is leveraging new technology to rethink existing payment, clearing, and settlement structures. How will all of this come together? And what will be the respective roles of the private sector and the Federal Reserve? Well, let's break it down, keeping in mind my basic principle that the Federal Reserve should focus on addressing issues that the private sector cannot address alone, and in doing so, promote an efficient and resilient U.S. payment system. I'll start by discussing the important roles that the private sector now plays in the payment system and in the evolution of payments underway. The private sector connects consumers and businesses to the payment system, with financial institutions competing to provide services to their customers. Such competition can lead to better products and services for consumers, as profit-seeking competitors look for opportunities to win over customers, including through the adoption of new technologies. I have noted my concern that some see these new technologies as an opportunity for the public sector to play a bigger role in payments, which in my view may crowd out private investment. I believe this would be a policy mistake, and a better approach is one in which the private sector continues to have a significant footprint with the role of government limited. One important reason for this is that the private sector, through competition, is typically best suited to sort out good ideas from bad ideas, rather than central bankers or other public sector institutions choosing winners and losers. At the early stages of innovation, the true value added of the application of new technologies is murky. Market competition helps sort that out and typically leads to a wider range of products that can be better suited to the needs of customers. But just as was the case in the time of Warburg, there remain problems in payments that can't be fully resolved by the private sector. And just as we have done throughout history, the Federal Reserve stands ready to support the evolution in payments and do so primarily through our operational role in the payment system by providing core clearing and settlement infrastructure on which the private sector can innovate. Notably, the Fed has the unique ability to provide the infrastructure to reliably settle interbank obligations using balances at the central bank, which enhances the stability of the banking system and the broader economy, reflecting the lessons we learned in 1907. Compared with many other countries where a small number of large banks dominate, the United States has thousands of banks and credit unions. Connecting those many organizations to a payment network requires a significant amount of coordination. This is a problem that is not faced by other countries, but we do. One recent example of an area in which we're playing such a coordination role, in my view, is in instant payments. The role we're playing with FedNow is to help that coordination problem using our existing connections to thousands of small institutions. And that approach is consistent with my overall view of the appropriate role of government, to narrowly address problems like those of coordination that can't always be efficiently solved by the private sector alone. In doing so, we complement the private sector and promote responsible and efficient innovation in the broader market. With respect to new and emerging technologies in finance, I can think of two ways in which the private sector is uniquely positioned to develop and deploy them, while the government is not well suited to do that. First is the question of innovation risk. The investment in new payment technologies is large and comes with risk of failure. Private sector entities risking their own funds and seeking to turn a profit will have a greater incentive to accurately gauge demand for those technologies and bring those products to market faster. Second, despite the current fascination around the world with industrial policy, rarely can the government match the ability of the private sector to efficiently allocate resources and explore how well new technologies can address actual shortcomings in the current financial system. It is too early to tell whether some of the new technologies will relieve significant frictions in the payment system, but it's going to be the private sector betting with its own money that is best positioned to explore and answer that question. If problems emerge, as they did with check clearing in the 19th century, then the government can play a constructive role in overcoming them. Well before this point, however, it makes sense for the public and private sectors to look down the road together and engage in dialogue about potential issues and opportunities that might arise. For example, through the Bank for International Settlements, the Fed is currently engaged with the private sector to explore how tokenization technology might be used to facilitate cross-border payments in a faster and cheaper manner. This project brings together multiple central banks and private sector financial firms in collaboration to potentially facilitate a better functioning monetary system. The process of working together to promote the efficiency and safety of the Federal Reserve, safety of the payment system, as the Federal Reserve has done for decades, can lead to outcomes that benefits households, businesses, and the overall economy. American entrepreneurship and technical prowess have generated exciting innovations in payments, and they will continue to do so. The role of the Federal Reserve is to support that initiative and engage with the private sector to promote innovation while guarding risk to financial stability. We've managed this balancing act before and will continue to do so. And together, we will ensure that the payments ecosystem continues to move forward for the benefit of households and businesses in the United States. Thank you very much. Bring Raj up to the stage. I told him, this better not be like I'm a witness in a jury trial.
And I will be sure to stay true to my promise. So let me start by thanking you for insightful comments today and for your personal commitment to the vitality and durability of our country's payment systems. This is not a subject that receives the headlines or the public focus of monetary policy or regulation. But as you pointed out, not only are payments now, but they're central to the well-being of the country's economy, way beyond even the banking system. And we're so fortunate to have you at the helm and your clear-eyed, thoughtful approach to this set of issues. So we'll turn to some questions now. The first one relates to attention, I think, between faster payments and compliance. And there's a recent speech perceptively pointed out, not that it played if I may, not all frictions that slow payments down are bad. Certain frictions are purposely built to deliver the payment system for compliance and risk management reasons. So could I ask you to expand do you believe there are actions that can be taken to speed up cross-border payments without diminishing efforts to combat illicit finance?
Right. So there's a big initiative around the globe to have faster, cheaper payments and safer payments. So I always like to say, it's like air travel. I want cheaper airfares, I want nonstop flights everywhere, and I don't want the plane to fall out of the sky. Right. And so that's kind of the idea of payments as well. We want faster payments. We want them to be cheaper, but we want them to be safe from fraud, safe from money laundering, for illicit finance and terrorism. And that's where, as Raj was mentioning, that's where the tension comes in. To make them safer, sometimes you have to slow the process down. Certainly, we know that with fraud. And then people on the other end say, I just want my money fast. It's like, well, slow down. We've got the safety part of it too. So that's what I've been trying to stress in my discussions with international counterparts. We want faster, cheaper, and safer. All three of those, not just the first two. And that's where I want the discussion to go. We can't always think about just making it cheaper and faster and throwing away, safety. I mean, many of us,
You stand in the security line at the airport, you're like, it'd be so much faster if I could just walk to the gate and I didn't have to do all this. And then you remember, I think there's good reasons I have to spend some time and slow down my trip to the gate, because there's good reasons for all the safety precautions that we have.
So let me focus on a specific here. You gave a speech, I think it was in India a few months ago, and you made a point which I certainly didn't realize, and I think it was critical to this debate. And what you pointed out was that most of the focus on faster payments is person-to-person remittances, but remittances represent only a small portion of the total value of payments. So this is a double question here. One, how important is it that your counterparts recognize that the majority of payments should dominate the conversation for the majority, the vast majority of payments? And number two, do you think there can be a way to do differently than other payments?
Yeah, so one of the things I've tried to point out on when everybody talks about faster payments, you have a receiver of the payment and you have a sender of the payment. The person receiving the money always wants their money fast. I never met anybody who didn't want to get their money fast. But there's lots of incentives sometimes for the sender to not want to send them so fast. Delay the payment, I'll send it to you later, or the intermediary. So there's a tension between the sender's incentives and the receiver's incentives. So when I've talked about fast payments, you have to figure out the use case. Why does the sender want to send the money faster? And remittances is a typical classic example. I want to send the money back to my family. I want it to get there fast, and I want it to get there cheaply. Once you get outside of that obvious case globally, it becomes very murky, kind of exactly what the business case uses sometimes are. In the gig economy, we see this all the time. People that want to be paid daily, I want to get paid daily. My employer won't do it. Go ask them why. But I mean, that's the point, is that the senders are firms that want to say, I'll pay my workers daily. Why do they want to pay their workers daily? Well, it turns out they have recruiting and retention incentives for certainly fast food employees or gig workers that they'll pay them to give them incentives to stay. So it's those kind of use cases you have to think about. And so, like I said, globally, remittances are a big thing. But, in the U.S., there's not a ton of remittances pouring into the U.S. Most of the remittances are going out. And so this is a public policy question of how important do we put that relative to other use cases that we're still developing in the U.S. for faster payments.
So let me turn now to a basic thing that you were sounding in your remarks, and that is what I would call the track payment system. And you mentioned you have several payment chips. You have each of the private and public sectors with ACHs, and you have FedNow and real-time payment. And so the private sector has its systems, the Federal Reserve has its systems. What do you see as the benefits, challenges, difficulties of the situation, but it seems to have worked exceedingly well?
Yeah, I mean, when I think back, one of the things I've tried to stress is that a large part of safety in the payment system is resiliency and redundancy. Nobody wants to get on a plane with one engine. All right? I mean, you want two engines for a reason on that plane. So it's kind of the same idea. You'd like to have multiple systems in case there's a problem or something fails in one, that you could easily switch over to another. That's my own vision of how I see ACH. We have the private chips. We have FedWire. These are the way we do this to make sure that if something goes wrong, the payment system doesn't go down. And banks use both systems daily to try to make sure they have operational risk. So that's a critical part, I think, of what the Fed does, is provide redundancy and resiliency to the system. That if you just have one system alone and something goes wrong, your entire payment system collapses. This is a situation you run into with PIX in Brazil, UPI in India. If those systems go down, their entire payment systems go down. There's no alternative. There's no switch where you can flip it. Okay, so that's where I think of the Fed with ACH in particular over time, Fed now. In some ways, we're just a resilient backup for how the private sector works.
And how do you see the cooperation between the public and private sectors in this area? Good dialogue? Is it taking place at the right levels?
Yeah, I mean, that's a critical thing. We want to think about these systems working away. It's just saying, if a bank wants to send some payments over chips, some over Fed ACH, that they can do that pretty seamlessly without a lot of differences in the way they do that. Make it simple. So we want that kind of cooperation, like the ISO 20022 system of messaging. We want consistent messaging across systems. This is a global thing. And this is all based on, agreement. Nobody can force anybody to adopt these standards. So they've got to have good reasons. There's got to be consensus. And then when that happens, we all move to that system. But that takes time. It doesn't happen just overnight.
So let me turn to payment system resiliency. It's a note you have already sounded. So we have cyber criminals, we have state actors, quasi-state actors who are continuously mounting more and more sophisticated attacks. What can both public sector, the Federal Reserve, and the private sector, TCH predominantly, do to withstand attacks on our critical payment infrastructure, because that's what makes this country go round? And what are your priorities in improving resiliency for both the public and private sector systems?
Yeah, so I mean, we typically always talk about cyber risk as being some nefarious thing that some bad state actor or foreign actor is going to impose on. But we just learned with the CrowdStrike problem that sometimes a cyber incident has nothing to do with malicious intent. It's just something bad goes wrong, and then we see what the consequences are. So probably CrowdStrike might be the biggest cyber event that the country has faced in a long time, and it had nothing to do with anybody trying to have ransomware or take anything hostage or disrupt anything on purpose. So, I mean, the lessons I've kind of taken is regardless of what the source is, whether it's malicious or not malicious, you got to have your systems ready to go. So obvious, these are simple 4 points, probably everybody in this room knows, but I kind of think of it as, first of all, you have to prepare in advance, right? We all know that these things can happen. Prep in advance, see how you're going to deal with it, who's going to be in charge, what's the process for recovery and rebooting the systems. 2, everybody's got to be involved pretty quickly. Too often these things are siloed. Oh, that team will take care of it. But the problems start multiplying fast outside of that group. And if you don't have people involved from the beginning, then you're trying to play catch up all the time, and the problem gets worse. Then the third thing is automation. If you can have these systems such that you can quickly reboot systems through automation rather than human control and not interference is the right word, but intervention, that's where it was. You can get these things up and running much faster than if you have a bunch of people having to talk to each other, get approval above, and do something. And then the last thing is one thing we've learned, I think, in our own payment system is, a cloud-based architecture gives you a lot more automation tools and resiliency than if you just were kind of doing things on your own. So, I mean, that's kind of the 4 points I took away mainly after the CrowdStrike incident to how to think about resiliency.
No, and I think that is a great point, that we look outward and don't necessarily look inward. And I'm reminded when you said that the largest bank systems failure, it was many years ago, occurred without an outside actor with its own systems, and the whole bank actually went down. So I think your point is so very well taken. So thank you for that. So you have mentioned a bit earlier cryptocurrencies, and a lot of focus on stablecoin, and questions for the regulators and for Congress about what is going to happen. And there is a specific concern about use of stable coins and other cryptocurrencies to support illicit finance. But we know, as recent events have demonstrated, that bank payment systems can support illicit finance, so it's not unique to how can these developments into stablecoin be measured, evaluated, and protected so that it does not become an avenue. We don't want to crush innovation for the reasons you mentioned. That's the focus of what should be the private sector. At the same time, there need to be the controls. So I wonder if you could expand a bit on your thoughts in that area.
Yeah, so in the crypto universe, you're trading all these objects. I've given some speeches on how I think about the crypto universe, but one of the critical things that popped up in trading in this world, which is a completely different set of rails, traditional rails, is that there's always a demand for a safe liquid asset, something with stable value that you can move in and out of positions. There wasn't such an instrument in the crypto world, so they created one. This is what you got to love about markets. There's a demand, there's a problem, they created a way to solve it. So they created stable coins, a dollar-denominated token that always paid off a dollar no matter where it was. Had various firms that provided these stable coins. Stable coins were just a solution to a problem that existed in finance in the crypto world. When you look at it, it simply becomes a synthetic dollar. That's the way I often think about a stable coin. A synthetic dollar. It has the same kind of properties in some ways as standard commercial bank money, that it can be used, redeemed at will. But because it's not backed by government, it's not backed by FDIC or anything like this, they suffer from run risk. You could see this with any of the stable coins. Back about 2 years ago when there was a crypto crash, there was a break in the peg on these things as people started running on the coins. That still would exist in anything that we would allow in the US through legislation. So what we would have to do is make sure legislation ensures, just like we do with banks, that if I go in and I want to convert my dollar in my checking account into a dollar bill, that I'm guaranteed I'm going to get that. That requires a lot of regulatory structure, a lot of things in the banking system to make that happen. You'd need a similar sort of thing with stablecoins. In terms of using it illicitly, again, that's where we want some information. We have to have some oversight and regulation of the stable coins. But they can potentially unlock a lot of, if you think about just a simple payment stable coin, not a banking function, but a true payment stable coin. There's a lot of potential to eliminate efficiencies in the payment system in various other ways, allow entry, competition, and whatnot. And the banks are free to issue it themselves if they wanted to. I just see this as something that can have a lot of potential benefits. It opens up new sets of rails, new sets of trading. But we do want to have legislation to make sure that they're pretty much run-proof. We have better insight as to how it's being used. Once you're on a blockchain, you can track where it went and who had it. It's a lot easier to track that than US currency, I can tell you that much. So when people are worried about illicit finance, you can track on a blockchain a lot easier where this was, who had it, and what it was being done. And if you can control the entry and exit points, it's actually a lot safer than actual US currency.
That's a great last point, that there are real advantages in dealing with illicit activities from innovation. It's not just open sesame. You made a point near the end of your remarks, and it ties with what you were just saying now, I think. And it's a key distinction, and that is between digitizing deposits and payments made out of deposit accounts and stablecoin. They really are different. And at least in my view, I'll see if you agree, but I'll ask you agree with the distinction. And then do you see, as I think you were indicating, that banks should not only have the right they need it to be able to digitize deposits, but separately and apart be an issuer or provide other services for stablecoin?
Yeah, I mean, the thing that's kind of funny is our financial system is already completely digitized. I mean, nobody's trading physical objects around on any given day. This is kind of a funny thing when people think about, oh, we got to be digital. We already are. We have been forever. When I was in India up until 10 something years ago, it was like 95% physical currency was their medium of exchange. So for them, moving in 10 years from 95% physical cash to 95% digital is a big innovation. But this happens for us over about 50 years. This is nothing really new. So all that matters is kind of what is the digital object that you're sort of using for payment. Tokenization is a way to take maybe your bank account and trade it on a different set of rails. The example I always use is you go to a casino, they don't let you use cash at any of the tables. You go to a window, they give you a token, you go around the table, you trade, it trades on that platform, and at the end of the night, you go and you cash it out back into cash. That's tokenization. That's exactly what people talk about when they talk about tokenization. You're just converting one object technically into another digital object that'll trade on a different set of payment rails. So for the US, it's just moving from a digital system we already have to slightly different digital systems as we move forward with things like tokenization, smart contracts, and whatever.
Thanks. Different subject, but also returning to something you mentioned. And we're only a couple weeks past Halloween, so I'm going to come up with a vampire image. I mean, and I think you said put it in a lead coffin, but I want to see if I can drive a stake through the heart. So you haven't had a answer for 3 years on CBDC. Is it really even on the radar screen anymore, or is that back to the past?
Yeah, I mean, there was a lot of excitement about CBDC, and it was like, look what it can do. It can do this, it can do that. And I viewed all that as kind of like an infomercial. What's an infomercial? Look at this. It minces, it mashes, it slices, it dices. Look at all the wonderful things it can do. But the whole point of an infomercial is to get you to avoid asking a simple question. Do I really need this? And that was how I look at all the CBDC excitement a few years ago. What are you solving by having this thing? And I literally just ask a question. I put it out. And globally, everybody's having a very hard time answering the question, why do I need this? What is it replacing that the private sector isn't already doing and doing well? And so I think as other central banks in the world have stared at that, they're starting to kind of walk back. Doesn't mean they're not looking at it. We're continuing to look at it. But you really have to ask yourself, what is the problem that this is solving? And if you can't answer that question, why are you wasting your time on this?
Okay, that sounded like a stake to me, I hope.
I have very strong opinions on it.
Let me turn to a subject on which I know you're going to be limited as to what you can say because it's still in the rulemaking process, and that's Reg II. But it is a critical issue for the banking system and apparently for the merchants and others. I'm not sure, but others. But in any event, is there any elaboration you can give? Again, stressing there are limits on what you can talk about.
Yeah, I'm very limited in what I can say. All I can say is we collected the 23 data, which has this kind of funny thing. We put the card not present rail requirement in about halfway through. So one of the things we're trying to sort out was, did that change things in the way, say, fraud cost should be calculated and whatnot? So we're still looking at kind of the data from 23, because it was kind of a weird thing to have this rule put in place about halfway through the year. And everything we heard was this had an impact on fraud costs that was different than card present. So we're trying to tease some of that out. Just to be honest, the legal uncertainty now around things with Chevron, Corner Post, all the legal cases, for me personally, I'm speaking for myself, I'd like a little more legal clarity on how the courts are going to be interpreting things like how we interpret Reg II before we put out a big, bold, brand new statement. So I'd like to see how fast that'll happen. I don't know.
I will editorialize and say there may be a wait. We've got to get to the district court in Corner Post. I think I can say with some degree of assurance that there will be an effort made by the losing side to appeal. And who knows whether it even goes to the Supreme Court. So it's a bit away. Let me turn again. I'm going to move around a bit. And you discussed the innovation in payments and the private sector and its importance. But a specific element is level playing field. I think there is no question, but there has been a substantial movement of payments activity away from the banking system into the non-banking sector. And I think it is also undisputed that the non-banking sector is subject to a lower level of regulation and supervision. But that doesn't answer necessarily the question of cause and effect. And so is this sectoral shift from banks to non-banks, how much is that due to the absence of a level playing field? Should there be a level playing field? We don't want to discourage innovation, but we also don't want regulatory arbitrage.
Right. So, I mean, you can think about, partnerships with non-banks or fintechs as kind of standard business contracting things out. We don't necessarily do these things well, or we don't have it to scale, so we're going to partner with somebody else to have it do it. That's just standard kind of business practice in any kind of industry. What's different about banking is we have a ton of regulations on banks because banks do a lot of different things, right? They provide all these things together. They have all these regulations put on them. And sometimes there's some gray area of, does this apply to this business line or not? And the way, this is me, just me, I'm not speaking for anybody else, but I often think of what, the non-banks and fintechs do is they take one thread of a bank's business and pull it out and say, we can do this better and more efficiently. Oh, and because we're not doing everything the bank does, we don't need the regulations that you put on a bank. But kind of in a simple principle that I kind of agree with, which is standard supervision, same risk, same regulation. So just because you pulled it out of the bank and put it somewhere else doesn't mean that it should be treated differently just because it's not necessarily in a bank. And I think that's kind of where we need to make sure that just because it gets pulled out of a bank and goes into some third party doesn't mean it's safer than if it's just done in the bank. And therefore, you need to make sure that the regulatory framework is consistent, no matter who's doing the activity.
Okay, I want to go back to your speech in India and a particular quote, and it was in a specific context, but I want to also try and elaborate a bit on it because I think this quote seems to be central as I've tried to read a number of your speeches to your overall approach. And what you said there was that economic viability needs to be a cornerstone for any action the Federal Reserve may take, and this was in the context of accelerating cross-border payments. But again, to me, that seems to be, as I said, a cornerstone of your overall approach. And you were really saying this in your remarks, I thought, that for the Fed to come in and take action, there has to be an economic case. I wonder if, ask you to elaborate a bit on that one.
Yeah, so I mean, ever since the Monetary Control Act of 1980, we've had to do cost recovery. We're not allowed to just subsidize activities with taxpayer dollars. And I agree with that principle. It's not my job to provide services on the taxpayer's dime, even if it's the taxpayers receiving the benefit. And that sometimes gets lost in how things across countries. Let me just say this. My global peers don't necessarily have the same view. They'll say these things are like public goods, having payments is a public good. The state should provide funding for public goods, so what's the big deal? Yeah, that's fair, but I still think it's not fair, and that's what Congress decided in 1980, that the Fed gets to do things subsidized by the taxpayers that the private sector doesn't get to do. That's the level playing field. So I believe in that. The other thing is you want to be able to sit down and say at the end of the day, is this a valuable service where the benefits exceed the cost? We know what it costs to run services. Is the benefit to the society worth providing those services? Let me give you an example. We created global ACH 20-something years ago because of this need for better global payments. We put a lot of money into it, we built it, and nobody used it. Well, we finally shut it down. I mean, we're not going to run this thing for decades and nobody's using it. So that is what I mean. At the end of the day, we can't just build systems and if nobody uses them, just keep paying for them and running them. At some point, you got to cut the cord and call it a day on it.
So your point struck a chord with me that in a number of countries, they may not have the same objectives we do or the same philosophy. How is that working in reconciling different objectives in the international sphere on payments?
Yeah, I would say in all my global interactions with people, there's a fundamental difference of whether the government should be a competitor to the private sector or not. Now, I have a very distinct capitalist American view that it's not the government's job to go out and compete with the private sector. The example I always use, no matter how much you may think EVs are a wonderful product, the government is not producing EVs. US government doesn't do it. We let the private sector do it. You may subsidize, but we don't directly compete with private firms. That is not necessarily the attitude in other countries, right? And it's certainly on payments. They may be, I don't know why payments is the exception, but they feel we need to get in and compete directly with private sector firms to drive down cost. That's not my job in the US, sorry. And that's often the tension I have with discussions globally.
So for the last few minutes, I'd like to ask about what is around the corner. That's what you see over the next number of years, whatever the perspective you'd like to take. And I'll start with the positive note. What are you seeing in payments that excites you about future prospects? What makes it so cool?
Yeah, so I mean, it was a lot of what I was said. If 20 years ago, you talk about payments, you think of somebody with a green visor, a dim light, and a ledger with a pencil writing stuff down. And now with like fintech and technology that's coming in, using the internet, apps, this is an exciting world. I mean, young people are excited about it, And to me, that's great because you're going to come up with ways of thinking about how to do payments, how they're going to be managed, how it's all going to be done. That, I'm not that smart. I can't figure all this out, but that's what I love about American capitalism. Let people figure it out. Some will work, some will not work. So I just find this a very exciting time right now for payments. Like I said, I also find it very interesting how stuff from the crypto world could potentially be brought over. Blockchain, tokenization, smart contracts. Forget the object that's being traded. I say this over and over. I don't care if you're trading Dogecoin or Bitcoin. I'm more interested in the technology and how that technology became transferred over to traditional type finance and banking to make it efficient, easier, faster. So that's the stuff I actually find kind of exciting about payments is all the technology stuff that's coming up. And, maybe I'm just didn't pay enough attention, but this seems completely new to me in the last decade than what we saw in decades before that.
So I know we have a panel later today dealing directly with AI, but it's sort of hard to talk about anything without referencing AI. So is that part of the technology advance that you're seeing in payments?
Yeah, I mean, the thing is AI has got a lot of buzz about it, but we're still trying to figure out what the business use cases for AI are. And usually for things that are going to have this is speaking as macroeconomists, things in technology that lead to longer term, broad aggregate economic growth, they have to be things that spread across all sectors. It can't be just a few sectors. That's not going to cause aggregate productivity growth. AI is not going to help you if you are in a nursing home and you need somebody to help you get out of bed. It's not going to do that. It's not going to fix your toilet. It might help the plumber fix it, but it's not going to fix it. So, I mean, there's parts of the service sector where it's going to be hard to see how AI is going to lay bricks to build a building or what, that's very hard to see how it's going to necessarily work out. But you can certainly see how it can be very good at other things. I have friends and colleagues, certainly coding, anybody here that does coding, this is just the way it's all done now. You just do it through AI. You don't deal with anything else. Like I was mentioning, if you were thinking about stable coins and you wanted to look for illicit financing things, AI can read a blockchain phenomenally and look for patterns. That's what it's really good at, generative AI. So people I've talked to said this will be a great tool for monitoring illicit finance, money laundering, other things, once things go into any kind of a blockchain, because it can just read it 24/7 and look for patterns that are suspicious. Maybe they picked the wrong thing, but that's what it's good at. So there's a lot of potential to use AI in the payment space that I can see.
So on the other side, and I hope the answer to this is you're sleeping soundly, but if you have a few minutes before you drift off, what does keep you awake? What are you thinking about over the next few years as to problems in the payment sector?
Yeah, I mean, again, it's always going to come back to cyber. Anybody that runs anything, this is the core that we live in is a cyber world. Everything, all of our operations, all of our businesses, everything we do is tied to computers and software. That's just the reality of it. And so we know that if those products, those infrastructures get corrupted, they get attacked, they get ransomware, you're in a lot of trouble. So this is the thing we always worry about no matter what you do when you have payments. Because they're all digital. They're all driven by software. They're all driven by computers. We're not passing cash, bags of gold around in carts in the streets of New York City. So that's ultimately always kind of what happens. I mean, the other thing that always is an issue is just kind of what kind of regulatory changes may come about, how things will be done in the political environment going forward that affect how we have to do things and monitor things.
So is there anything that I failed to cover that you think it's important to?
That was pretty thorough.
Okay. All right. Well, then, since we're within a minute, I'm told my primary responsibility is to end on time. I do want to come back to your airport analogy, going through the lines. But when you get ready to board, they board the military, and the statement is, "Thank you for your service, Governor Waller. Thank you so much for your service."
Thank you very much.
Thank you. That was great. Thank you. I enjoyed it. And that's